Markets continue to panic. The stock market continues to go down as markets freak out over what's going to happen on the 2nd of April, which is what Trump calls Liberation Day, the day that the US will impose reciprocal tariffs on all the other countries. So is it a time to panic and get off the market, or is it a time to be greedy when others are fearful? Well, let's find out in this video. The S&P 500 just closed March as one of the most bearish months ever since February of 2022. So the month of March was down over 8%, and the last time we had such a bearish month was back in 2022 February over here, just before the 2022 bear market. So the market is freaking out because of what is going to happen on April the 2nd, which Trump calls his Liberation Day, the day where the US is going to impose reciprocal tariffs on all the countries in the world that have tariffs imposed on the United States. And you know something, Trump does have a point, because if you take a look at this chart, you may not know that for many years, other countries have huge tariffs on US goods and on goods from other countries. For example, Argentina has huge tariffs, UK has huge tariffs, Russia, Saudi Arabia, Australia, they all have huge tariffs. And the country with the least tariffs, which is the most open country for imports, is actually the United States. So what Trump is saying is it's so unfair because of this, we are losing tons of exports. And he does have a point. So what he is saying is on April 2nd, the US is going to go tit for tat. Whatever tariffs you impose on us, we're going to do it back to you. And the market's freaking out because they don't know how extreme this is going to be. Because if all these tariffs come into force, this could cause US growth to slow down, even tip the country into a recession, and it could create lots of price hikes and spike up inflation, creating what we call a stagflation scenario. The market's pricing in the worst case scenario, and basically many institutional investors, they do not dare to own stocks until they know what exactly is going to happen, so they're selling out before this Liberation Day. So is it a good idea to sell as well, to get out in case things look really bad? Well, based on history, I can tell you that every time the market anticipates a particular day that is going to be very bearish, it usually doesn't happen that way, because the market again tends to always be overly pessimistic. The market tends to price in the worst case scenario and think we're going to die. And then when the day actually happens, the market goes, okay, it's not as bad as we thought. We didn't die, and then the market starts to rally strongly after that. So I'm not surprised if this happens again. Again, I can't predict the future, I don't know 100%, but I think there's a pretty good chance that when April 2nd comes and goes, the market will get a sigh of relief, like, oh, okay, it's not that bad as we thought, and that's how you get a reversal from this correction. So I do think that it is possible that April 2nd, or in fact, maybe even a few days after that, could be the potential bottom of this correction. And knowing Trump, if you take a look at his patterns in the past, he always comes out aggressive, like, I'm going to do this, I'm going to do that, I'm going to kill all of you. And then suddenly he goes, okay, this guy's a nice guy, I spoke to this guy, I'm going to give a lot of concessions, and it's not as bad as we thought. And that's what bottoms the market. There are a few clues that tell you that actually these tariffs may not be as bad as what people think. The first thing is, if you take a look at this chart, you notice that the US main trading partners that will be the most affected by the tariffs, like China, Canada, Mexico, their stock markets are actually doing pretty well. So the US market year to date is down 4.94%, but China's stock market is up 19%. Mexico's stock market is up 6.85%, and Canada's stock market is only down 0.56%. So why, if the tariffs are so bad, why aren't these trading partners getting hit really hard? So something tells me that a lot of the sell-off is not really the tariffs. It is something else. So what's that something else? Well, let's take a look at the next clue. If you take a look at the different 11 sectors of the market, now which sectors are the most affected by tariffs? They would be the material sector. The commodity sector is very affected by tariffs. Chemicals, paper products, building materials, and other type of raw materials. But year to date, the material sector is up 4.9%. How can that be? Now, at the same time, while certain technology stocks in the hardware electronics industry will get hit by tariffs, but the majority of technology stocks nowadays are software companies like Microsoft, like ServiceNow, like Salesforce, like Palantir. They are not affected by tariffs, but why have they sold down so much? Doesn't make sense. In fact, technology is the worst performing sector, down 11.96% year to date. Communication services that include Netflix and Alphabet and Meta platforms, again, they are not affected by tariffs, but they are the third worst performing sector this year. So how can that be? So once again, this tells me that the majority of the sell-off this year has not been broad-based across the market. In fact, you can see that in the market year to date, energy is up, materials are up, healthcare is up, utilities are up, financials are up, consumer defensive is up, real estate is up. The only thing that is down this year, again in a big way, technology, consumer cyclicals, communication services, and industrials. And out of these four, once again, technology and communication services are not affected by tariffs. So why are they down so much? I think the main reason they are down this year is because these three sectors were the best performing in the last 2 years. They generated the most profits for investors, and as a result, investors, after making so much money in the last 3 years, institutional investors, they are basically taking profits. They are taking profits on those where they made the greatest gains and rotating in those other sectors where they feel is more undervalued right now. So it's because of this rotation. And if you think about it logically, like for example, when I look at my portfolio, I've got over 40 stocks in my portfolio. And I ask myself this question. I say, if I look at the underlying businesses, are they really affected by tariffs? And the answer is no. Most of them are not. In fact, out of all my 40 stocks, the only stocks that are affected by tariffs potentially would be Apple. All right, and Apple only has a 2% allocation to my portfolio. The other possible one would be Nike, and Nike has less than 1% allocation to my portfolio. So Nike, Apple, and the other one possibly in a small way Amazon, because Amazon's an e-commerce company, so tariffs could increase the cost of the products which they bring in to sell. All right, but then again, remember that out of the e-commerce sales, the majority of Amazon's e-commerce would be third-party sales, which means it's not Amazon's inventory. Amazon's actual inventory they sell is a small percentage. And the majority of Amazon's profits is not e-commerce. It is cloud computing, it is advertising, it is logistics. And that is not affected by tariffs. So what I'm saying is that my portfolio is down as well this year. It's down about less than 4% in fact, all right? And many of the companies that I own, are down, 10, 15% from the highs, especially my tech companies. Am I concerned? Not at all, because I look at my companies like I own Amazon, I own Alphabet, I own Salesforce, I own ASML, and I ask myself this question: did their sales drop? No. Did their profits drop? No. Did the intrinsic value decline? No. So these companies are the same company that they were 2 months ago when they were selling at all-time high. So the business itself has not changed at all. But the share price is selling at 15-20% less. And it's got nothing to do with the company. It's got nothing to do with tariffs. The prices are lower because of the overall bearish sentiment that's caused by, again, massive profit taking. And for an investor, I love these reasons why the stock goes down. Because the business is fine, and this gives me an opportunity to build more shares if I don't yet have a full position. All right, so if you're someone who's wondering, why is my stock down? Look at the business. If the business is doing well, don't be concerned about the short-term price fluctuation, because once sentiment shifts, the prices would revert back to their intrinsic values and back to all-time highs very, very shortly. All right. Now, if you take a look at these three sectors, you would also notice that in the long run, it is these three sectors, which are technology and consumer discretionary, that outperform the S&P in the long run. And they did outperform in the last 2 years. So the reason they are down a lot this year, again, is profit taking, or could be market maker manipulation, trying to push these prices down to scare out retail traders to throw their stock so they can build their positions themselves, those bastards, right? Now, if you look at the communications sector, it was only recently created in 2018, so you can't really compare it. Because previously, Alphabet, Netflix, and Meta, they used to be under technology, but they were reassigned to a new sector called communication services. And it was only reassigned in 2018, so it's not a fair comparison. But if you actually compare from 2018, you can see that communication services also outperform as well. Now, the majority of my companies are in these three sectors, and that's why I outperform the market in the long run. So when you see these three sectors correcting in the short term because of profit taking, to me, it's nothing to be concerned about. In fact, again, I see a lot of high quality companies in these three sectors that are looking attractive. For example, take a look at Amazon. Amazon's intrinsic value in my calculation is about $221. It's now selling at $190. It is currently undervalued and looks pretty attractive. Again, this is not a recommendation or advice for you to buy Amazon. I already own Amazon and I will add more if it does get down to even more attractive levels. The reason I'm not buying more right now is because I already have a lot of Amazon that I've bought years and years ago, right? But I'm just showing you that these are companies that are high quality, that are attractive. Another example, of course, would be companies like ASML, right? These are monopolistic companies and they sold off, for no good reason. My valuation of ASML is about $797, is currently at $662. And again, it's pretty undervalued. Another one, Microsoft looking pretty attractive as well. Intrinsic value is $415, and right now it's $375. I'll share one more view. Nvidia, everyone's favorite, right? So Nvidia is worth at least $130 based on my estimates, and it's now at $108. I'm greedily waiting to see if we can hit below 100 to buy, but I don't think I would get it. I'm hoping it's going to go down, but I don't think it's going to go down. Damn it. But the reason I'm not adding more here is because I already have a lot of Nvidia, right? It's one of my top 5 positions that I bought, started buying at $15 years ago. So, but of course, if I didn't have any Nvidia now, I had no Amazon now, I had no Microsoft now, I had zero now, would I start buying now? Yes, but I already have a lot, right? So for me, since I have a lot, I will only add more if it gets to ridiculously even lower levels, which I don't think it will, but let's see how it goes. Now, once again, let me answer this $1 million question. How much lower can we go? Now, I already said this in my past video, and have I changed my opinion? No, same opinion. So I already said in my last video that currently we are going through a correction, and a correction is very normal. You had at least one correction a year. Once the market drops 10% from the high, it is called a correction. And right now we are just below 10% from the high, although we did rebound a bit yesterday, right? So if this is a normal correction, then at the very most, I think we will drop down to, at the very most, we will bottom at 5357, okay? Now let me say why, because if you take a look at, again, previous corrections, when the market, remember, market goes wave up, wave down, wave up, wave down, wave up, wave down. Market moves in waves. And you can look at the pattern of the waves over the long run, right? So you can see that when the market goes through a normal correction, it tends to bottom at the red line, at the 20 EMA. You can see it corrects there and toing. So if it's a normal correction, you hit the red line and toing, right? So this red line here, which is the 20 EMA on monthly candles, that should be the bottom of this correction at the very most. And right now we're down 10%, so to get to that level would be down another 2 to 3%, because the average correction would be about between 10 to 15%. So this would be, again, the average correction, which I think it is. Now, you may say, but what if it's a bear market? Is that possible? Of course, everything is possible. If the economy does tip into recession, if Trump goes full crazy mode and he goes too far with tariffs and we go into recession and the bear market, which is unlikely but possible, then where could we go? Then we could possibly go all the way down to this blue line here, the 50 moving average. Because once again, if you look at history, when the market goes through a big bear market, it tends to bottom, bottom at the 50 blue line. Doing, doing, doing. So doing here. And that would be over a 20% drop from the high. That would be a bear market. You'll bottom somewhere here and then hallelujah, right? But again, this is if we get a recession. So what is the probability of a recession right now? Well, if you look at the FRED, economic data from the St. Louis Fed, the probability of recession now is somewhere around 26%. So that's relatively low. If you take a look back in the end of 2023, the probability of a recession was actually about 78%. And back in late 2022, the probability of a recession was over 85%, of which in both instances, there wasn't a recession. So right now, relatively, it is still pretty low. Although Goldman Sachs did say that based on their estimate, they are estimating the probability of a recession right now at 35%, which is still well below the 50% mark. If you take a look at the Atlanta Fed latest GDP now estimate, they are estimating that Q1 GDP is a contraction of 1.8%. That is scaring people, but like I said in my previous video, it is because of a big surge in net non-monetary gold imports, probably to escape Trump's tariffs. So if you actually look at the alternative model forecast by the Atlanta Fed, which adjusts for imports and exports of gold, and you discount that, then the actual GDP now estimate for Q1 is still positive at 0.2%. So not as bad as what it may seem. Alright, so to summarize, April the 2nd, I wouldn't freak out, I wouldn't sell because of that. And like I said, most of the time, when the market expects a very traumatic event, it normally turns out not as bad as people expect. And normally the market tends to bottom on that day itself or a few days later. And that's when the correction is usually over. No guarantees, but I think there's a pretty good chance it would happen. Now, taking a look at the charts of the S&P 500 on the daily candles, what is pretty interesting is that we actually made a low right there and the market rallied. And then we had this scare because of inflation data being a bit higher than expected, and the market, came down again. But you know what's the funny thing? Why did the 10-year Treasury yield not spike up? Why did the 10-year yield go down? Because if the 10-year yield goes down, that means that there isn't really a fear of inflation. So I'm beginning to doubt the validity of this sell-off beyond the market makers doing what we call a bear trap, or doing what we call a taking out of stop losses by retail traders to force their stop losses and then run the market higher. So for those of you who have taken Alson Chu's price action manipulation course, this is known as what we call a classical double bottom or false bottom pattern. That could be a potential bottom. Again, there's no guarantee. Technical analysis never guarantee, but could this be a potential bottom? Especially with April 2nd coming up really soon? Yeah, this could be a potential bottom. So don't be surprised if it is. But if it isn't and it breaks down, then like I said, I think that at the very most, we're looking at another downside to 5,357. The other piece of bullish data point is that seasonality. Based on seasonality, April, by the way, is one of the most bullish months in a trading year. And we are now in the month of April. And Carson Research, they just posted this, that usually, if you get a very bearish March, April tends to be even more bullish. So based on the last 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 years of very bearish Marches, you can see that the following April, that follows the March tends to be higher 80% of the time, with an average return of 2.9% and a median return of 2.0%. So I think the odds do favor a bullish April coming up. Let's see how it goes. Thank you for listening, and may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.